better than Nikhil Nigania, the senior analyst at Bernstein, joining in on the show right now. Nikhil, hi, morning. Great to have you today on the show. Thanks for taking the time out. Nikhil, first, give us the big picture. Why is power, along with its ancillaries, just so hot in the market?
For sure. So, see what has happened in the power sector is we have had like a decade of poor performance, right, for the sector. And now suddenly we are, two things are happening. One, we are in a tight power demand supply situation. Hence, we are seeing deficits in power. And second, at the same time, we are trying to do energy transition as well. And maybe to a third point to add to that, the receivables for the power sector companies have also improved. So hence, given these three factors, I think we are still in the early stages of a multi-year cycle in the power sector. We think some of these demand supply challenges will continue for some time. We think the receivables should stay good. And the renewable commitments, as you would have seen, 2020 have been to triple it, the capacity in renewables by 2030. So that's where we are. So it's still early stages of the cycle. And so good times, looks like good times ahead for the sector.
Okay, that's a categorical call coming in. But tell me, who stands to gain from this entire capacity addition that one is seeing right now? I mean, does the right to win stand with the PSUs or private? And should you even be making that kind of diversification or distinction?
You raise a valid point. See, in terms of how to play, there are three areas. One is the developers, then second is the equipment players, and third is the financiers. And we have the options between PSUs and private names in most of these categories. The advantages, if I talk about developers, the advantages PSUs have against the private players, especially in a sector like renewables, is renewables are a relatively simple business to execute. Hence, the biggest differentiation is the cost of borrowing, which is a clear advantage for PSU names in the sector, like NTPC, which has been one of our top picks since we initiated in August this year. So PSUs do stand to have an advantage there. And then even if you look at the power financing names, companies like PFC, REC, who are largely exposed to lending to this space, given the kind of loan book growth that is expected for them and the lower risk of NPAs, they stand to gain as well.
Okay. Let's understand within power producers, utilities as we call them, there are two types of players. One, those who are focusing on pure thermal, like NTPC, and then you've got folks which are now moving from thermal to, let's say, other sources of energy, Tata Power. Looking at the narrative of the world where energy transition is at play, what would be the relevance of, let's say, a thermal-backed utility 3-5 years from now? Because markets will start putting a terminal value, and if the terminal value is contracting, obviously stocks will come down.
No, fair point. But we have to realize, see, as a country, India, we don't have a lot of natural gas. We don't have a lot of hydropower capacities, about 47 gigawatts. We don't have a lot of nuclear either. And hence, if you talk about different times of the year, let's say the month of April, when it's peak summers, hydro generation is low, wind generation is low. How do we meet the demand in the evening times of the day at 7-8 p.m.? That is when thermal becomes very critical. I think India has realized it, and that's why the targets for thermal have been revised upwards from about 50 gigs of thermal addition in 10 years to almost 80 gigawatts of thermal addition now. So to your question, next 3 to 4 years, we don't see the relevance of thermal coming down. Actually, even till 2030, we don't see any decommissioning happen for thermal plants, or rather additions of thermal plants should continue. And the targets, as you've seen, they've been revised upwards. So thermal will be very relevant. The only risk to the thermal story, I would say, is the battery prices. If battery prices crash, then there's a risk the thermal addition might not happen to the extent envisaged. Otherwise, they are very critical for India as a nation.
Right. Nikhil, while there's no doubt that this is a story which is here to stay and perhaps a decade-long story, if not beyond, but the fact of the matter is also there's only that much that you can pay as a price for value on the table. Do you think there's exuberance when it comes to the financiers? I mean, we all know what happened with the IREDA IPO. There's still a lot of FOMO feeling out there. And look at what names like PFC, REC have done. What do you have to say about that?
See, these names, I think they had a poor performance the last decade was largely due to the loans extended by them to thermal power plants, that too by private entities. That's when the risk comes when the government entities are lending to private players, especially in a sector like thermal, where it's a long duration project, 5 years plus. In some cases, the PPAs were not signed, the coal linkages were not there the last time. But this time, if you look at these companies, just to caveat, we don't cover these power financing companies. But just to look at, if you look at the loan book of these companies now, what's driving the growth is largely renewables. And renewables by nature are much less riskier to invest in or to lend to than a thermal plant or a hydro plant or a biomass-based plant. And hence the risk of NPAs to these entities are much lesser. We are almost seeing a catch-up game, I'm guessing, from PFC REC, which is about anywhere between 1.3 to 1.5 times book value towards an IREDA, which is almost 2 times book value right now. And PFC RECs, for that, they do have an advantage of being a Maharatna company. They can borrow cheaper in the long term. And a lot of their loan is government to government, which is less riskier as well. So we think there's still value. There could be value there in these names, given the loan book growth and less NPA risk.
Wanted to get in your take, in light of the interest rates coming down, what exactly this means for some of the power utilities?
But that is definitely a very clear advantage. So if you think of a renewable plant, especially an operational plant, for a renewable operational plant, the revenues are locked. The tariff is locked for 25 years. And on the cost side, they have hardly any operating cost. For the solar plant, for example, the only operating cost is just cleaning the solar panels, which is just like dusting and removing the dust from it. The biggest input cost for them is the interest rate, given they are typically 70 to 80% leveraged solar plant. And hence, as the rate starts coming down, automatically you should see a rise in return on equity for a renewable plant. So that's been actually one of the largest reasons why renewable companies did not do well this year, calendar 23. And if going forward, if the rates start correcting, it should definitely be a big positive for renewable companies, especially.
Right benchmark metrics to understand power utilities. Price to book is one, future rates is one, demand is one. What is the right way to look at them?
So the two most common metrics we use in the sector, one is price to book, obviously, and the second one is EV EBITDA. Basis these two metrics is where we compare in the companies in the sector. So if we talk about developers, for example, the private players are almost 3.5, 4 times book value, the likes of JSW Energy, Torrent. Then there are some which are still at lower book value, trading at lower book value, like CSC, which is about 1.5-ish. And NTPC now is almost 2 times book value. And if you look at the last power cycle that we had long back, NTPC had reached a price to book of almost 4x that time. We don't think that will happen, but there's still there is room for upside, and one could enter at dips.
So to cut the summary of our today's discussion, and for those who are watching this show, power stocks on an average have seen a 80 to 100% run up in last couple of months. That's the average. Your view is that the earnings is going to be strong, and for those who are buying power stocks now also, in the medium term, there is scope for capital appreciation because the earning is that strong.
Correct. In the medium term, we don't see the deficits, etc., going away. We see the growth being strong, and we see the returns being good on the P&L balance sheet side for these names. So we continue to be positive on the medium term for the sector.
About 3 criteria, 3 pockets in which one can really invest in the power cycle: equipment, financer, and utilities. Utilities, you like NTPC. What about financiers and equipment companies? What do you like there?
Finances and equipment companies we don't cover, but finances, as I said, there is a valuation, the relative valuation play which is there, right? PFC REC trading at a lower multiple than IREDA. So that is one potential play which is there. And on equipment names, the challenge is a lot of them have run up a lot. While usually the equipment names benefit the most in a power cycle because they are short cycle, they get money fast, they don't have the long 25-year risk, and the margins can expand. But a lot of them have run up. On the construction side, we do cover L&T, which again is a second pick after NTPC in our coverage, which does the EPC work for the sector.
Great to have you today on ET Now. And as our common friend would say, that power is clearly tick boxing all of those check marks for investment right now.
Yeah, I mean, power sector, hard to find a fault, to be honest, except probably if the demand growth next year slows down, then you could see some near-term corrections happen in the stock. If demand this year, it's been very strong. August, September, October, it's 10 to 20% power demand growth, which we saw this time. And if next year the demand disappoints, that I would say the only risk. Other than that, I mean, sticking the boxes in terms of demand-supply mismatch, in terms of capex intensity, in terms of improving returns and better receivables.
Right. Okay, Nikhil. Good chatting with you. Thanks so much for taking the time out today.